Hello, everyone, and welcome to Know Your Shit podcast. We're on knowledge and pride in what we do drives us to be excellent. My name is Josh Cadillac, and once again, I'll be in the driver's seat for today's show as we learn how to stop just chasing paychecks and how to start closing customers for life. And one of the things that we love to talk about, that we love to do, is to invest. We always love to encourage people to invest. It's one of the ways to close customers for life is to encourage them to have more of the product. And in the process of doing everything that I can to try to help folks with that, some of the folks that I work with, some of my friends, some of my colleagues, some of those folks that I've had the privilege of getting to meet want to know more, want to take and really put some meat on those bones. And Josh De Sousa is here with us today. He's a member of the Mastermind. And he said, you know what? Let me bring you a deal and let's take a look at it. So we're going to look at it and I'm going to ask the questions and kind of go through this in the way that I would underwrite this, so that we can figure out what the right answers are for Josh and at least what the directions that he should go. So you are stuck with two Joshes today, Josh in stereo. I hope that those listening get a chance to enjoy. So Josh, if you would tell me a little bit about what it is that you got going on and what you're thinking about doing.
Yeah, absolutely. Thanks a lot for having me on, Josh.
Cool.
Really excited to be here. So I have a quadplex in Rhode Island, where I'm originally from. I've had it for about 8 years now, and I have roughly around a 30% loan to value on that.
Okay.
And
So
after
that's 70%
spending,
equity.
yeah, and after spending some time with you, like I was always after chasing cash flow. But really, after hanging out with you and the Mastermind, really understanding the way to build wealth is to leverage the equity and continue to grow the portfolio. So, yeah, man, I have some questions on how and some suggestions on how I should move forward.
Well, sure. I love what you're saying there, and I think it's important to have our head wrapped around, exactly what the benefit. I mean, cash flow is great if you need it, but realistically, where we need cash flow typically is going to be later on in life when our earning potential is down. Now we're in real estate, and it's nice to have that extra income to kind of stabilize things if necessary. And I'm not opposed to a real estate agent having a couple of properties that they keep around for cash flow purposes if their business is really unstable. But let me ask kind of the basic questions, just getting our head around profitability and what the right way to go might be. What did you buy the property for, if you don't mind me asking?
I bought it for $330 back in 2017.
Okay, and what would you say the value of the property is today?
I think between 850 and 900.
Okay, fantastic. And so what kind of cap rate are you achieving with the property based upon that valuation?
A 6% cap rate. So
your valuation is based upon a 6 cap. Okay,
yep.
Fantastic. So we're looking at about $500,000, give or take, of capital gain that there is of equity appreciation that's in the property. So right now you're depreciating probably about $260,000 of total asset value, something like that.
Yep.
And so the question then becomes, I know what we've talked about in the Mastermind and the general concept of, it's about time to shed that asset and go to a newer, bigger asset. What are the assets that are out there look like that you could go to? So, I mean, with liquidating your position in the asset, how much debt do you have on there?
So I did a cash out refi a few years ago. Okay. I owed like pretty much what I bought it for, around $330.
Okay, so $330. So if you were to liquidate your position, you're probably looking at a rocking around with about $450,000 in cash.
Yeah, that sounds about right.
All right, so $450 in cash. Let's say you're able to go to 65% LTV. I don't know, you want to go much more than that because cash flows aren't that great that necessarily would support that. So it's 65%. Let me go ahead and do a screen share here for you. Never mind, this is not Zoom. So 450,000. If we're going to say that's 35% of the loan, 0.35. It means we can borrow about $1,250,000. About $1,200,000 is what you're looking at as far as buying power goes today. So at $1,200,000, let's say at a 6% cap rate, let's use the same valuation. You're looking at 72,000 in net operating income. If you're borrowing, we're going to say it's about $800,000 in order to take and do that. Interest rate today on that paper is probably 7.5 at least, maybe even a little bit more for 30 years on a DSCR loan. You have $67,000 of annual debt service, which is leaving you only about $5,000 of positive cash flow if you go maximum leverage. So the question that would immediately have to go to, Josh, would be, and it's more personal. If you don't want to answer it, it's fine. But the consistency of your real estate business, how much is the income from that property really necessary for you to survive?
Yeah, that's a great question. Because I
I try
did.
to only ask 3 questions. I don't always get away with it.
Um, so yeah, I was thinking about that, and I've been investing since that was my first. This is the first property that I bought that we're talking about. But I've only been a real estate agent here in Florida for a year now. So
Mm-hmm.
the first 6 months, no way I could give that up. But now things are starting to move. I'm making some income. Um, I feel like I can cover that. I also
Mm-hmm.
have another quadplex in Lake Worth in Palm Beach County
Nice.
that I also, uh, I got some good cash flow on that too. So
Okay.
don't want to sell both of them. I have about the same amount of equity in both,
Mm,
but I've only owned that one for about 4 years now.
mm.
So really, what I'm giving up is like 50% of my passive income. So I'm going to hold on to Lake Worth, and and
Well, I don't know that you're giving it up. You're just getting it someplace else. So, one of the other things that we could do, that we could look at, is being a little more conservative with what we do. So instead of going 65% LTV, going closer to 55% LTV, borrowing only 600,000 instead of 800,000. Well, then your cash flow, your debt service is 50,000 a year as opposed to $72,000 in income. So you're 22,000 up. You're about 2 grand good to the good per month. This right here that we're talking about, Josh, and this is kind of what I always try to do. I know that you've heard me talk about, how to maximize, how to squeeze everything you can out of the real estate investment. I will always try to take and say, here is how far the rules will allow us to go. That doesn't mean we have to go to the edge of the rules. All right. Like the human body can only sustain acceleration at this speed. It doesn't mean we have to take and see, whether or not we can detach our retinas with acceleration, right? We're able to take and step back from that. And that's one of the concepts. I know you've taken the class before for me, where we talk about sizing the investment to the investor, the idea of managing the risk profile of the person we're talking to. And that's kind of what the conversation we're talking about right now is, which is how much appetite do you have for risk in this? And what I mean by that is, if this property is underperforming, do you have cash flow from other sources where you could cover it if there's a month or two where this property is coming up short, where a couple $1,000s needs to go back in? In the long run, it should more than compensate you for that with all kinds of other benefits that you're going to get. But in the short term, in the process of dealing with this illiquid investment that we have, this cash flow differential investment that we have, these are all things that are very personal decisions that you have to make, recognizing that whatever you choose to take and do to reduce risk also is going to reduce the maximum amount of upside that you're going to get. You're no longer, in this example, appreciating $1.2 million. You're appreciating $1 million. You're appreciating a bit less
Mhm.
than you were before. So all of that becomes a decision to make. But the positive, the big reason to look at doing this is right now you're depreciating an asset that you're depreciating at $250,000,
Mhm.
let's say. Well, now you'd be depreciating 800, 900, maybe $1 million worth of real estate, which means your real estate tax deduction for depreciation quadruples. This is going to take and protect more of your income. Right now, you're paying a lot of taxes on the income that property generates because very little of that income is being protected from taxation because of the depreciation. The depreciation number is low. It's based upon your original purchase price, not based upon the true value of the asset, the highly appreciated value of the asset. So, does that all make sense?
It does. Thank you.
Okay, so what we are going to need to do, the next question is going to be, what do the available assets look like that you could repurpose that capital towards? I mean, you got a fourplex in Lake Worth. Are there a couple other fourplexes in Lake Worth that you're looking at? Is there anything that's getting you feeling warm and fuzzy in the Shorts region? Because that's
So a couple things. Either another quad, something similar to Lake Worth. I see the potential there. There's a lot of building going on there. But then also this South Florida condo market, we're seeing so much inventory, a super strong buyer's market. I'm not sure it's like I'm ready to pull the trigger yet on that. I still think there's some more time that's needed before we do see a bottom or an equilibrium with all this assessments. And those are the two avenues or two options that I'm looking at.
I totally agree with you as far as staying away from anything that market is not stabilized even close. So the question is, are there opportunities out there where you feel like the price makes sense? Because if you're going to stay in the fourplex type region, then it probably makes sense to buy two if you can, rather than one, from a standpoint of flexibility. If you can make the money go that far between that and the debt.
Okay.
Does that make sense?
Absolutely.
I mean, the other option would be to take and go with something that is bigger, more units. One way or the other, we're always trying to take and increase our unit count if we can.
Mm-hmm.
Get as many units under management as possible, especially when you're in the build phase.
Right.
It gives you the lowest future vacancy potential as you go. We're trying to take and broaden the portfolio. I mean, the part that hurts with the cash flow is that you can't really stockpile the money to buy the next one, but that's not how you're going to do that. You're going to stockpile the money to buy the next one by the equity that builds up in the property based upon the higher valuation of the property, that number appreciating over time. That's where the money's going to come from. And so the next play would probably be a cash out refi after 5 years, as long as the equity is there, and using that to go buy because it does not create a taxable event.
Mm-hmm. I
can take the property. I bought it for, you buy a couple of fourplexes for $600,000 a piece, right? Well, now they're worth $1 million, and you've paid down some. Well, now you take and you pull out another $400,000 from each of them, and you go buy a couple more, right? That's the way we do it, because otherwise, if the cash flow is what we're using to stockpile, the cash flow we're getting nailed at our ordinary income rate for every dollar of cash flow it brings in. So the sweet spot to kind of be in, Josh, is to have it generating enough income that it covers all of its expenses, the reserves, anything weird that comes up, but not enough income that it's going to exceed our tax deductions. Or if it does, it exceeds our tax deductions to a very small extent. Yeah. Because then I'm getting that real tax deferred and tax-free growth that's going to allow me to have something when it is time to retire. Because here's the cool thing. When it's time to retire, when it's time to take a step back, you can completely change your investment strategy to focus now on more cash flow. Right? You can take and sell a couple of assets and pay off the debt on a couple of other assets. There's all kinds of things that you can now do to take and reduce but now you're getting taxed as ordinary income, but with the reduced income of not having that day job that's bringing in the income that your real estate business should be, and then having the income from the top property on top of that, pushing you further and further up those tax brackets that you're getting hit harder and harder as you make more money. it's a way to take and keep your silent partner, Uncle Sam, from taking a bigger bite than he absolutely should, right? We want to minimize his ability to take a slice out of the pie. And so it's just where we get the wealth from. It's nice. The cash flow tends to be the the drug. We like to see the bank account balance going up. Um, but if you've done this for a while, you go and you look a couple of years later and you're like, holy crap, look at what my property is worth. That's all tax deferred. You don't pay any tax on that growth until you take advantage of it with a sale and you do 1031 or you refi. Both of those are ways to take advantage of that growth without a taxable consequence.
Cool, man. Thank you.
Yeah. So I would say that the next step for me, Josh, would be because I don't want to start the sale until I know that I have, a reasonable idea that I can get what I want or something worthwhile, right? So I'd start scouring the market as I start putting feelers out in that other market in Rhode Island to look for buyers,
Yep.
right? Because you got to make sure that while that 6 cap maybe looks like it's where things are, making sure that you'll actually be able to get a valuation based upon a 6% return on the property, making sure that carries water. Make sure that you have your financials nice and tight. Just because it's a fourplex and most agents, just put down the gross rents and whatever. If you could provide good financial backup for where you're getting your numbers from, and also a good pro forma there, make sure that all of your leases are annual leases. All right. If you're month to month with any tenants, make sure you get them on annual leases. A property is more valuable with annual leases because if the leases are annual, it's easier for the person buying it to get financing.
Mm-hmm.
And that opens the door to more people being able to afford the property.
Yeah. Another question was I'm thinking is everything's under lease until I think the first one will expire in July or August. And
Mm-hmm.
that specific unit is the first floor. So like perfect opportunity for an owner occupied, a first time.
Sure.
So that's why I was thinking about maybe waiting a little bit longer till like June to
I,
have
you
that
know,
option for someone to open up that option for those buyers.
you
What
know
are your
what?
thoughts?
I love the idea, Josh, because I don't mind putting a property under contract for months to give somebody an opportunity to queue that up. And especially considering, I mean, like maybe it's the advertiser in me a little bit, but putting something out there, start the year right. Here's a property where you can take and use your FHA, VA, whatever, to get your first investment property and have 3 tenants paying your mortgage. I mean, there's just so many things that we could say and do with that, with the idea that it's the beginning of the new year. As of this, I don't know when this recording is going to come out, but we're just after the new year. There's a lot of people that's their resolution is to take and get their first investment property, to stop renting, to start buying. So kind of leaning into that and being the person, because I mean, to you, how beautiful is it if you could get under contract in February or March, knowing that you have till July before you close to
Mhm.
start working on identifying your property, because your clock doesn't start that 1031 exchange until you close.
Okay.
So, I mean, I know that leaves a lot of time for something bad to happen with the buyer on this deal, but that garbage can happen even with a shorter period of time. With a 1031, what I'm always looking to do, always, is try to find ways to buy myself as much time within that 180 days to delay the start of that 180 days as long as I can, and to make sure I've got something isolated before it even gets going. I mean, there's nothing better than an almost simultaneous close on a 1031 exchange,
Mhm.
where I close the one, they take the money, put in the other one. I don't even. I almost don't even have an interruption in cash flow going from one deal to the next. Right. So that would be the other thing, because the one thing I never want to see, and it's just because I'm grumpy like this, I don't want to see you paying taxes
Right.
if you can avoid it. So that would be the thing that I'd be looking at. Kind of, this is the being the maestro, if you will, and conducting this orchestra of getting everybody on the same page, and then making sure that you have a good 1031 intermediary. That fellow that was in the Mastermind the other day would probably be a great option. That guy really had his stuff tight. Really thought he was a good resource for that.
Cool.
So what else? What else were the questions? What other strategy stuff do we need to look at?
I think that's really all that I have top of mind right now.
Okay.
Yeah. But on a
All right.
side note,
Cool.
man, just want to thank you for everything. I
Oh
think
yeah.
my story, your story resonates with me. Year ago, I had no other option. This was my only option. And the first 6 months were scary.
Oh my
And I was this close to throwing in the towel. But I came across you at the association, and being a part of the mastermind and getting to know you. It's I can see the light at the end of the tunnel, and
God. Oh man,
and
I love to hear
it
it.
feels good. It feels good. So I just want to thank you so much, Josh.
Oh man, thank you. That's why I do what I do, and knowing that it's actually doing what it's supposed to and helping people is well, you know quite a bit about me and how much bigger this is than just any kind of a paycheck. So yeah, man, that resonates very much with why I do what I do. So I'm glad it's getting you there, Josh. And man, if there's anything you need, I'm always pretty quick to answer if I can help. So yeah. All right. So some things to sort out on your end, some questions to answer, some assessment to do. But by all means, man, let's expand that portfolio. Let's be looking middle of this year, the latest, to have you into owning at least 8 more units if we can.
Let's do it, man. Thank you so much.
All right, brother. All right, for all of our listeners, thanks for hanging out with us on what is a shorter session, but hopefully chock full of fun stuff as we look to understand how to underwrite. Reminding you guys always, there is never a good excuse not to know your shit. Till next time.